Hi, everybody, and welcome along to this next session of the Greenwich Economic Forum. My name is Katie Martin. I'm the markets editor at the Financial Times here in London. There's quite a lot of people in the office today, as you might be able to see behind me. We are here to discuss investing after COVID with a US and global perspective. The pandemic has obviously shaken some of our key assumptions about markets, but also deepened some big trends that were already in place. Perhaps most notably, it's really squeezed down those already tiny government bond yields. And so to make returns for their stakeholders, asset managers need to look further afield, often leading to unusually risky territory. I have an excellent panel of speakers to talk about their experience of this in no particular order. They are Marcie, who is the CEO at CalPERS, the Californian Pensions Manager, Mikkel Svenstrup, who is the Chief Investment Officer at the Danish pensions group ATP, and also Colonna, who is the President and CIO of Lockheed Martin Investment. Thank you all so much for joining me from your particular corners of the globe. I have loads of questions for these people, but if you in the audience have your own, then please make sure that you send them in the little widget on the screen. We will have time to deal with questions from the audience, hopefully towards the end. But perhaps to kick off, I'd like to kind of ask each of the panelists to talk about what their organizations do, what kind of stakeholders they have, and really what the biggest change has been since the COVID pandemic came along. Marcie, why don't you kick off? Tell us a little bit about CalPERS and about the biggest changes at your place over the past 18 months.
Thank you, Katie, and good morning, everyone, or good morning from here, good afternoon in other places. So CalPERS is a pension and healthcare purchasing institution. We're the largest US pension plan. We also are the largest healthcare purchaser, public healthcare purchaser beyond the federal government. Our stakeholders are wide and varied. They range from labor organizations. We have 3,000 public employers who are participating in the plans. We have very active retiree organizations, all obviously concerned about the sustainability of our fund and the continued ability to pay these benefits. For COVID and the pandemic, being a long-term investor, we certainly haven't made too many tilts. We worked on our liquidity management side, and really are watching the Feds and what they're doing with tapering and asset purchases, looking for that high quality fixed income, and then certainly wanting to increase allocations around private assets, as you indicated, that chasing return when you're expecting to discount your liabilities at now 6.8%, and bond yields are essentially at net zero. That makes it very difficult to not have to move up on the risk spectrum, but happy to talk more in detail about that later.
Yeah, that's obviously a huge theme for all of us. It's one net zero target we've all been able to reach. Mikkel, how about you? What has really changed at ATP?
Well, I don't think we, if you look at the investment side, we haven't changed too much, to be honest. That's a short answer. But first of all, good morning, everybody, or good afternoon. ATP is Scandinavia's second largest pension fund. We operate a scheme that's about $150 billion, and we provide a mandatory product to all Danes who participate in the labor markets, and we are about 5 million, so it's about 5.3 million members of the scheme. It's basically a defined benefit scheme with a lifelong guarantee. We haven't changed too much. We can get into it. We haven't changed too much about we operate, but I think there's one notable thing that we did change, or I've been working on under COVID, is that ATP is governed by the law passed in the Danish government, and that law was updated this year, and hence in that situation, and it allows us actually to increase the risk budget a little bit in our portfolios, and it's going to change a little bit in the product as well, which I think is the third time in reality since '64 when we were started up. So it's actually, in that sense, it's a big thing. It's a milestone for us, and we're going to implement that over the coming 2 years, I think.
Yeah, good stuff. And Paul, what's your perspective?
Yeah, thanks, Katie. I run the wholly owned investment subsidiary of Lockheed Martin, and so we're a corporate pension plan. We run not only the pension assets but also the 401k assets, and really for us, it's about helping the corporation in terms of funding status, and that's really a blend of de-risking the portfolio there and thinking about risk management, but also seeking return profiles in this market environment. And then on the 401k side, during COVID, and what's the biggest thing that's changed for us? We were able to launch and land an entirely revamped 401k platform for our participants. Over 100,000 participants, and so we've simplified our investment lineup. We've created new investment structures and vehicles for them, and so we're trying to optimize their personal outcomes and try to improve their retirement journey as they go through the corporation.
And so the kind of key thread running through all of those is effectively this huge cram down in government bond yields globally. I mean, Mikkel, there's a school of thought that bonds are dead. Unless you have a regulatory obligation to hold bonds, you should just steer well clear of them. How does that view sit at ATP?
Well, the fact is that we run our investment portfolio. The way we organize the portfolio is it's split into a hedging portfolio, which we hedge 100% of interest rate risk, which we've been doing since early 2000s. That's been a phenomenal decision to keep that, not calling the bond yields at all-time low. But to be fair, right, the investment part of our portfolio is run by basically four factors: equity, rates, inflation, and something we call the other factor. And we still have around, it's not a risk parity portfolio, but it's inspired by it, and about 30% of our risk still comes from fixed income. So for us, it's significant amount of risk that we have, but obviously, and we are able to run it as a levered investor, and hence, there are still yields to be had in interest rates. I think this year, obviously, I think for the first time in many years, we had negative results on bonds, but we actually had a very positive return on our inflation portfolio, which is, so I think the strategy and the portfolio construction actually does what it's supposed to be doing.
Yeah. I mean, Marcie, what kind of challenges has this thrown up to you with what we've seen in bond yields?
As we have fairly significant equity exposure, and looking to fixed income and bond yields to be a diversifier in the portfolio, also being that initial building block as we look at how do we move the portfolio closer to our assumed rate of return. But again, we have to watch this for the long term. And again, we know we have to invest in those private assets, but we really look at it for diversification. And we're taking the board through our asset liability management cycle right now. We've submitted a number of portfolios to the board for consideration, and really looking at whether we have to do our strategic asset allocation a little bit differently this time, where we look at the immediate upcoming, say, 5 years, position the portfolio in a certain way, understanding that these yields are likely to stay fairly low into the near future, and then the following 15 years really adjusting and tilting the portfolio appropriately. But that diversification remains important. It's in the California Constitution, and we can't just chase return without having a diversifier. We have to be really careful about that volatility, the funded status, and that sustainability of the fund for decades.
Yeah, exactly. It's you can't just switch your mandates around like flipping a coin. And Paul, what kind of difference has it made to you? Are there sort of new higher yielding opportunities that you've been looking for as a result of what central banks have been doing effectively?
Yeah, I think for us, and maybe picking up on what Marcie was saying, obviously in our pension fund, the one benefit that the interest rate markets have is that they are, they're a hedging, vehicle versus our liability stream. So they do have some just inherent benefit in terms of that. The problem is, most of those cash flows are valued pretty dearly right now, and so it's not a great moment in time to be adding, I think, especially to the treasury market or even the high grade markets. And so, Katie, to your question, I think that's put us out on a journey to thoughtfully find, and these are longer dated cash flows too, in the private markets, whether it be infrastructure or real estate or other segments of the market that kind of tend to fall between the cracks of, of the fixed income markets. Most of the private, fixed income or higher yielding fixed income market tends to be floating rate, shorter duration. We're actually looking for longer duration cash flows to provide the hedging component that we need, but then also provide some incremental yield and return. And I think you have to go to some different places in the market to find that. And it's not something that's going to just be dropped in your lap in terms of a big fund mandate or an easy over the counter type of transaction. No,
exactly. And I think possibly we need a new name for the high yield market, because it's not so high yielding anymore. But you allude to something there, which is valuations. Is your sense that how comfortable are you with valuations now? Do you feel like there is going to be a pullback in markets broadly in the next few months?
Yeah. I mean, maybe if you're going to be, Katie, I think certainly on the fixed income side, we don't see a lot of compelling reason, to hold fixed income assets except for their hedging, components. And so we feel like, you do in general as a multi-asset portfolio, you do want to be, in the equity markets or other markets away from fixed income. But even the equity markets, we're, just tactically speaking, we're having the debate right now in the portfolio between now and year end, how much do we hedge, tactically for the portfolio. We're not thrilled with valuations. Having said that, we believe that the 2 to 3 year look on where we are in the economic cycle and where we think valuations could go, and relative returns could go versus other asset classes. We're comfortable with the equity market, but we're tactically having a moment around hedging right now.
Yeah. Not thrilled with valuations is an extremely diplomatic way to put it. I mean, Mikkel, are you thrilled with valuations? How nervous are you getting around the sort of exuberance that we're seeing in markets at the moment?
Well, you know what? We're in for the long run. We don't try to time tactically our exposure. We do have a mandate to take the risk in the portfolio up or down, and we do that once in a while. But for us, it's still about I think looking back, it's always been. There's always something that you should worry about. If it was easy, everybody would be making a lot of money, right? And we're getting paid to take risk. And I think if you look back, a lot of people have called the bottom both of and the top of the equity market and the bottom of the rate cycle for a long time. And I wouldn't be the guy to call it either way, to be honest. We try to diversify, right? We try to keep our risk exposure and protect our capacity to take risk, and then we're gonna stick in it for the long run.
Yeah, I mean that seems to be the tactic now, even for people with a shorter time horizon. I mean, Marcie, where do you fit in that? Are you getting nervous about the direction of markets towards year end?
Yeah, I think we are positioned in the same way as my counterparts on this, that we are long-term investors. We certainly think valuations are lofty, but just something that we're watching in our risk portfolio. Taking the board through our asset liability management cycle right now, our current portfolio sits at approximately 6.25, and it's expecting a 7% return. And so building that pathway in these candidate portfolios between 6.25 and our current expected rate of return at 6.8, we certainly are concerned about market volatility. The board is very concerned about risk mitigation. The portfolio has been more defensively postured since 2015 with a number of factor weighted equities, which is really helping with some of that volatility, but also a pretty significant allocation into long treasuries. So we're watching it, but being a long-term investor, we're not doing any significant tilts in the portfolio at this time.
Yeah, that makes sense. But you are looking at the broad strategy for CalPERS, right? I mean, what new areas are you considering getting into?
Well, we have to look at the alternative sides even more significantly than where the portfolio is positioned today. We currently have an 8% policy target to private equity, but we know that asset allocation process that we're taking our board through now, that it's likely that asset class needs to move from 8% up to either 12 to 13 to get to that 6.8%. So it's going to continue private equity, private debt, direct lending, some infrastructure, increasing our real assets allocation as well. That is going to continue to play a very important role in getting our rate of return. So we're really, right now, we did a 20-year look back at our private equity program and found really some, the attribution of, failure to meet our benchmark over significant periods of time, essentially was inconsistent capital deployment, throughout the vintage years. It was the stopping of our co-investment program, which has now been reinstated, also helps with that fee drag that can come with private equity. And then also the separately managed accounts where we're, sitting alongside another GP, where, we'll get a lot more involved and engaged with our general partners is a better alignment of interest between the GP and LP community. That might be items related to, ESG as it's called, although we prefer now to call that just sustainability. But we're looking at increases in allocations of, places we're investing today, but we want to do it in a more high quality way and have better relationships with those GPs out there and be more consistent over longer time periods.
Yeah, that's an interesting shift. I mean, Paul, this shift over to private equity, to private debt, it is kind of becoming quite democratized. Lots of different investors are looking at this space now. What are the pitfalls that you can fall into when you're looking at this sort of investment strategy?
Yeah, and we all know the numbers, right? And we all see the fund sizes growing exponentially, and it's quite frankly, it's a great time to be a private equity manager. Having said that, I think the pitfall for us on the asset owner side is, look, you have to be aligned. I mean, anyone can just look at a page and look at a newspaper, look at a book and say, look, we want to be in the private markets, but are you willing to build the infrastructure and team and process to succeed in finding managers and really approaching the market in a way that's going to provide an optimal outcome to you? And I feel like there's probably a lot of asset owners out there who are not going to do that. And I think we can all see the historic returns on private equity. Just to use that as an example, you have to be in the top quartile or slightly above median to really make it worth your while. And there's a lot of underperforming managers out there. Let's just be honest. And so you have to develop a team and a process and a philosophy and resource yourself. I think asset owners traditionally under-resourced, and so we've spent a lot of time and focus making sure that we can resource ourselves, making sure that we can take advantage of co-investments to kind of drive down fees and provide better investment outcomes. And so I think that the pitfalls really end up being around the strategic outlook and the ability to execute on the private markets from the asset owner side.
As you say, not all private equity managers have got the best track record. Mikkel, what do you think about this space?
Well, just first of all, right, ATP has had several approaches. One, we have a fund of one ATP private equity partners. It is probably a top 10% percentile. It has done tremendously well over the last 20 years consistently. When that said, we also do other funds and co-investments and directs in some cases. So we look at the entire chain. My concerns at the moment are basically that the kind of inflow to this market is, there's a lot of allocated capital waiting on the sideline, and that at some point that's going to burn in the pocket. So I think that is going to be some of the challenges that we're going to see for the next period. Everybody changing so much capital chasing the same deals.
Yes.
I think, but to be fair, if you look at it as a more on an overall level, do we think that the private equity create value? Definitely. The question is, how is it split between GPs and LPs, and how to get the alignment and the incentive structures adjusted and managed so that we handle those situations.
And as you say, with this money still sitting on the sidelines that could go into this asset class, what do you think should or could happen to fees in this sector?
Well, let's say, either you're a price taker or you're a price setter, right? So, and at the moment, everybody with the kind of ball of money. Everybody's price takers, right? So fees are not going to move on that sense unless you can bring some other value to the table, right? Expertise, knowledge, access to certain things, or any position you have, right? So yeah, definitely size matters, but also what if everybody brings capital? Everybody brings long dated capital to the place at the moment, right? To the table, everybody's there. So you need to be able to differentiate yourself to figure out what additional value can you bring into a deal.
Yeah. And Paul, what's your experience of activity in the direct lending market? Again, what are the pitfalls there? What's the specialist knowledge you need to do that stuff well?
Yeah, I mean, it's I think, look, it's an exciting market right now. Again, a lot of people are trying to build or develop platforms, and when we've looked at a bunch of those transactions, which I think is actually pretty interesting, providing capital to folks who are looking to build out that piece of the market and then taking economics along with them. But I think the pitfalls just in direct lending, I mean, look, it's all about the documentation. It's all about managing, and look, some managers just do it better, and they manage the covenants and they manage the process, and they're kind of true lenders, and they understand kind of long-term lending, and they're not gonna go covenant light and kind of all these other pitfalls. But that's just in our perspective, that's probably just a fraction of the direct lenders out there, and they know their core skill sets, and they understand the industries that they're in. And so I just, again, it's back to some of the other comments we've made. I mean, look, there's so much capital out there, and I think there's so many people that I think it's hard to imagine valuations changing dramatically just because there's so much capital out there. Having said that, I think the outcomes will be differentiated between the really good managers and the managers at the bottom of the pack.
Yeah. Marcie, you're nodding in a way that suggests that this is extremely familiar to you.
It really is. I mean, we about $40 billion of our portfolio into this asset class. We, for an extended period of time, we're overly concentrated in the buyout space. But frankly, we think that we can use our high yield team out of fixed income to do a lot of the underwriting and the due diligence, make sure that governance and the covenants are better aligned with the priorities and the mission of CalPERS, which is that really long dated capital. But we're finding some improvements in this space as we are expanding our program and hiring, being able to hire the right talent at CalPERS, not to do it specifically directly. We don't necessarily have the platform to do that, but more directly through these co-investments and through these separately managed accounts. That has been a significant improvement in our program over the last 24 months, and really has moved the allocation from about 6.5% of the almost $500 billion portfolio up to over 8%. And we won't see the benefit of that for some time, 5 to 7 years, and hoping what we're putting in the ground today will actually get us the return that we think we'll do. But having a 44% return, and we don't pay that close attention to a 1-year return, but a 44% return out of that asset class is important, as well as when we're looking at asset allocation, the capital market assumptions, whether those are short-term or the actuarial assumption long-term. Private equity is really the only asset class still that is projected to return greater than the 7%. So it's really important and necessary to the portfolio.
Yeah. Now I want to shift gears slightly and talk about possibly the number one concern for asset managers at the moment, which is inflation. It's an incredibly uncertain outlook here. Everyone's kind of got the textbooks and done their Econ 101, but we don't have a model for what's going on at the moment. Mikkel, what's your outlook here? How nervous are you about what we're seeing in inflation patterns globally?
Well, as I said, we have about 15% of our risk in the inflation factor. It has not been performing well the last many years. And this year it's been a tremendous run for us on that factor. But to be honest, right, we don't know what's going to happen. And to be honest, I think economic theories on inflation, whether it's monetary or Keynesian, all the good storytellers out there, let's just put it mildly and say that inflation dynamics has not been particularly well understood. And obviously we know what's going to happen with both equities and rates. If inflation do really spike, it's not going to be pretty. But on the other hand, you're taking for granted it's going to happen. And so to be honest, the best predictor of inflation for the has basically been the markets. Break-even inflation has been beating any other political forecasters or economics, whatever it is, and markets still think it's going to be transitory and we're going to be relatively low.
Paul, do you have the answer?
No. I don't have the answer, but it's the it's probably the most debated topic in our shop right now, and look, we see the evidence coming in. It's clear. We look at our real estate partners, and rent growth is 15-20%, and so that's actually happening. And obviously, we can all see the price of consumer goods that we all face, and so I think it's clear that we're in a moment of higher inflation. I think for us, we do tend to look through that, and we're still, I think, looking through that here, because I really do believe in the when I say the longer term, the next 3 to 5 years, I think we're going to be in an environment that is much more based on demographics and technology and some of the factors that were in place before COVID, and I think will be in place again. I look at the companies we invest in, and they all have longer term plans for efficiencies and automation, whether it's AI or robotic process automation, and so they're all trying to be more efficient. So I feel like there's a significant amount of long term tailwind to a generally lower inflation environment. Having said that, I think we're in for a period here, certainly of higher prices and services and supply chains and rent growth and all these things that we're talking about. But the longer term picture for the moment, I think, is still one of generally lower inflation brought on by, I think, those longer term secular trends.
I will put you down for team transitory, probably.
Thank you.
But Marcie, what's your view? Is it a big talking point at CalPERS as well?
It is, certainly something the team is watching what's happening with the Feds on, asset purchases, watching the markets. We don't necessarily believe that the markets are fully aligned with, the inflationary indicators that we're seeing around real estate, that was already mentioned, around, and just food generally. Inflation, we're feeling inflation in our households, but we don't necessarily think that the markets have priced that effectively yet. But again, watching what's happening with the Feds and the stimulus here in the United States anyway. And, it's something that we'll continue to, look at in the portfolio. Inflation protected securities have performed pretty well in the last quarter to 2 quarters. But nothing that we are tilting the portfolio or, we'll do some scenario analysis on it, but, we'll look through this and again, that long-term investment horizon allows us to look through various market periods and, really understand what to expect and to communicate to our stakeholder groups appropriately about what to expect. But we do believe that returns are going to be muted into the future, and we think inflation is going to be certainly a part of that. Inflation helps on the asset side, but it's a real problem on the liability side for us.
And you talk about the household experience of inflation. I suspect we've got quite a lot of that coming our way in the UK soon, because our energy prices have just gone through the roof because of what's going on with natural gas and our lower reliance on coal. It's a neat segue for me over to a discussion around sustainable investment, which, Marcie, I know you've already raised. Lots of asset managers, lots of pension funds are retooling their strategies to deal with sustainability. Does it have to be inflationary, do you think?
I don't think it necessarily has to be. Our sustainability strategy has been around, being this very strong advocate of, with the regulatory environment. We've pledged to be net zero in our portfolio by 2050, but we're really doing it through that 3-pronged approach around advocacy, the integration, and then some work that we're doing, Climate Action 100 plus, which has approximately $50 trillion in assets behind that now. Some successes through proxy that we've seen more recently. But sustainability is, to us, is that we have long dated liabilities, and we need companies to think about the long term and not just the short term returns. And we think that the CalPERS voice can certainly help in that we're understanding how they're managing the risk, how they're managing the just transition. We know it's expensive to transition some of these companies into carbon neutral by 2050. But that integration into the portfolio is not about divestment of these assets. And we get a lot of pressure at CalPERS about doing divestments from fossil fuel or divestments from coal, which we have done. We have fully divested from coal, divested from tobacco. But what we found when we produced this annual report is some of those divestments really have not paid the fund appropriately. And it would have been better for us to stay involved, stay engaged with some of those companies. Certainly a coal company can't transition away from its core of what it does. But for us, it's that engagement and really positioning the portfolio and understanding that if we do need to move away from a company, a country, or a commodity, that it's based on an investment decision and not a political divestment decision. And we have to be really careful there. We have 2 million members in the system who are really relying on this benefit to be available to them when they retire. And we just have to be really careful that, this is a trust fund and we need to invest appropriately. But, that sustainability of the fund is extremely important as well to those 2 million members. So we look at it from the climate side, we look at it from the human capital side, we look at it from the governance side. But we really try to be part of a coalition. A single voice at CalPERS can't really make these changes. And so we try to be, a significant voice in a coalition with similar outcomes. And so that's really where we are on the sustainability side at this point. Integration into the portfolio will really be based on the data. And where we're pushing right now is there isn't enough normalized data that is investor quality for us to make these decisions. So we're spending a lot of time there, both on the public side as well as the private market side.
Yeah, as you say, it's very difficult to keep all stakeholders happy with this process. I mean, Mikkel, where does this fit in at ATP?
Well, I think a lot of similarities with Marcie and CalPERS, right? And we have a broad member base. Actually, the laws for ATP stipulates that we need to maximize return for members. But I think for ATP, being one of the first movers on sustainability and ESG, it's been integrated within our investment process for a long time. So I think at least for the next many years, I think that the pressure, there's going to be a lot of opportunities, and we need a lot of capital deployed to actually transition the world to a net zero world, right? So I don't think that there's going to be over the long term, there's not going to be a lack of opportunities to invest. I think there are also opportunities short term, right? If you look at ATP, we were along a few other investors who bought at the time was a utility company in Denmark. We transitioned that into being a global leader in offshore wind, and one of the greenest companies in the world. That is I think as an investment, it was great, but also as a story, right? It's better to be invested and help the companies transition instead of just buying them whenever they have become green or whatever you want to call it. So we really work on the effect and not just divesting for whole sectors. My personal opinion here as well, that if we need to succeed with the whole net zero and for the benefit of the world, is a global problem. There are some industries that we need to bring into the discussion. We can, who are the experts, who have the infrastructure, who have the network globally. Think we can invent a parallel energy system without involving all those expertise. And I think that's, if we want to get to the right place, which we are all interested in, they need to be part of the solution.
Yeah, it's a good point. Sometimes divestment just isn't the answer. I mean, Paul, where does this all sit at Lockheed Martin Investments?
Yeah, I think we're at an interesting point in time right now in the cycle of ESG or sustainability, however we want to couch this. Just only because if you walk into any asset manager, this year or last year, the top of their strategic playbook in terms of growth opportunities is ESG. And maybe multi-asset solutions or something like that. And so, the whole industry is focused on the product side of this. And so we believe at Lockheed Martin that, sustainability is just good business. So any business should be doing it. but I don't know if I need the label to tell me that. And I think that's what I worry about right now, is that the industry is so far ahead on this. They're creating products, they're focused on the labels, and I don't need the label. And, and I think like was previously said, it's integrated into our business. And so actually what I'm trying to achieve with my participants is making sure that I communicate to them that they're getting sustainability in their investment process, and don't focus on the label, because if we start focusing on the labels, then that's where we get product proliferation, fees go up, probably performance goes down, because now it's just all about, it's a product push from the industry. And so I think we really have to be careful about that. And I think we have to stick to what I believe is our core, over the last, decade or two, which is, it's just good business. And we're going to hold our managers accountable to have a process and philosophy, that incorporates sustainability, label or not.
Yeah. But are you seeing more demand? I mean, that's been one of the really big shifts over the past 12 months or so, is that stakeholders are demanding something they can point to easily demonstrate that they're doing this.
Yes, and I think that's part of the problem, is that everyone then just looks to, look, I need the label. I need someone to tell me this is what it is, and that's how I know. And we're actually trying to go against that tide a little bit and say, no, you're actually getting sustainability, and there's no need for us to pay for a label or be forced into, some product that the asset management industry is pushing on the asset owners. And so it's a tough, because again, it's easy, right? Very easy to say, hey, look, we got the label, check the box, we're done. Yeah. Label, mission accomplished. And I think there's more nuance to it. And I think there's ultimately a better outcome for asset owners than just going after the label.
Definitely. Marcie, we're running slightly short on time, but is that a challenge for you too, to explain this process to your stakeholders and to get past the kind of box ticking stage of sustainable investment?
It is. I think, our stakeholders' view of what success looks like in this space is different than, what we believe success is. And, having, 3 new directors go onto the Exxon board through shareholder activism, that was a success, but it wasn't divestment. And so trying to find a way to get a little more congruent with our stakeholders, and, some certainly understand that we can define success differently. We're all working toward this 2050 net zero. But I do agree with the labeling. The labeling is a real problem, and there's an F missing in the ESG, and that's the finance or the fiduciary side of the responsibilities that we have of managing the trust fund. So we prefer, and you'll start hearing CalPERS speak about this more directly, that this is really about sustainable investing, and sustainability is extremely important to, again, our 2 million beneficiaries. But we have to find a better way to explain the actions that the funds are doing that don't fall apart once you get 3 questions in about how are you doing this. And that's been some of our experience. And we have to be cautious of, I think the term out there is greenwashing. And the way that you avoid the greenwashing is you actually determine the metrics, you work with the companies, and then you track those metrics over long periods of time to see how they're moving from that baseline forward. And we have a lot of ideas about how to do that. We've been working with a number of companies and getting very positive feedback there.
Yeah, but it's not easy, and the data is not great, as you say. But listen, we're all out of time. It's been a really interesting discussion. We've run right to the deadline. Thank you to all 3 of you for sharing your time today, Mikkel, Paula, and Marcie. It's been really lovely to talk to you all, and I hope we can do it again soon.
Pleasure.
Bye-bye.